Hello, dear viewers. Welcome back to our channel, where we dive deep into the latest political economic happenings around the world. Today, we're focusing on the economic drama unfolding in the Eurozone, and it's not a pretty picture, folks. After years of hanging on by the skin of its teeth, the Eurozone's labor market is beginning to show cracks, and investors, central bankers, and the market itself are all feeling the heat. In simple terms, the golden age of resilience in Europe's job market is slipping, and the consequences could go way deeper than many might expect. But before we move forward, let's break this down for both everyday followers and those of you in the financial sector alike. From soaring inflation to lagging industrial growth, weak Chinese demand, and competitive disadvantages compounded by the grinding gears of ECB monetary policy, everything is lining up for a potential economic storm in Europe. So, grab your coffee and buckle up as we delve into exactly why Europe is stumbling, and what this means for the broader global economic landscape. Spoiler, it doesn't look good. First and foremost, all eyes are on the Eurozone's labor market, which has, until recently, been remarkably strong despite various pressures like skyrocketing inflation and a sluggish economy. However, what we're seeing now is a slow but steady unraveling of that resilience narrative, and policymakers, especially at the European Central Bank (ECB), have taken notice. Let's look at some numbers. Employment growth has slid to just 0.2% in the second quarter of the year. That's hardly something to celebrate, especially when juxtaposed against the region's high inflation rates and broader economic stagnation. On top of that, vacancy rates, a reliable indicator of market optimism, have dropped to just 2.6%, down from a peak above 3%. These aren't just random numbers floating around. They paint a picture of deteriorating confidence among businesses, particularly in their willingness or ability to hire new staff. And things are about to get worse. Major European companies, including giants like BASF SE and ThyssenKrupp AG, are already offloading staff in numbers that could signal even darker days to come. And that's not simply a management decision. This is a reaction to a basic economic reality. The math of keeping employees on payroll just doesn't add up anymore when profits are squeezed by an impaired global demand structure and an uncompetitive cost base. For instance, look at Volkswagen AG, one of Europe's industrial heavyweights. The company is considering closing plants in Germany, no less, for the first time. That's staggering when you think about it. When companies like Volkswagen, an industrial behemoth, start pulling back on operations that are so intrinsic to the country's identity, it's a direct reflection of where things are headed. And that direction isn't exactly filled with rainbows and sunshine. But Volkswagen isn't alone. Continental AG, another key player in Europe's industrial scene, is facing similar troubles. Personnel cutbacks are on the rise, and consumer demand has remained tentative, which means services aren't stepping up to fill the gap left by declining manufacturing. What? Low consumer confidence during inflationary pressure? Surprising. Not really, but that's part of what's driving this downturn. Over at Goldman Sachs, their analysts are not mincing words when it comes to the labor market. They predict the euro area unemployment rate will rise to 6.7% over the next several quarters. Some say that's optimistic, and if the economy underperforms, that forecast could go even higher. Now, let's turn to the European Central Bank (ECB), because they're not just sitting on their hands. Oh no, there's a real pivot happening here. Given the current state of affairs, the ECB is under significant pressure to cut interest rates, and quickly. This is a critical turn of events because, for the longest time, policymakers were proud of the euro area's seemingly bulletproof labor market. That was their crown jewel. Cue Christine Lagarde, the ECB's president, who, back in July, was chest-thumping over how healthy the labor market was. "We have time to gather more information before making a move," is what she said in essence. Well, it's safe to say that time is running out. Let's get into the crux of the ECB's conundrum. Unlike the Federal Reserve in the US, which has the dual mandate of both maintaining price stability and aiming for full employment, the ECB's official mandate is strictly price stability. This means inflation, not directly employment, is what they're supposed to focus on. However, like we've seen post-pandemic, the reality on the ground requires flexibility. With inflation still uncomfortable despite some recent relief, the ECB has been forced to reconsider how its actions, especially reversing its tight monetary policy, could impact the labor market. For even the hawks, yes, the ones who want to keep interest rates high to tamp down inflation aggressively, there's been an acknowledgement that if labor market conditions start to seriously deteriorate, inflation is not likely to remain high for long. Lower wages, rising unemployment, and shrinking growth prospects are the biggest drivers leading the ECB to start thinking about loosening its monetary policy. As Philip Lane, the ECB's chief economist, noted, a stronger labor market increases the likelihood of attaining their holy grail, that famous 2% inflation target. However, and here's the kicker, making labor markets too tight, i.e. with too many unemployed workers, could backfire. Moderation is key. Right now, wage gains are already slowing, which relieves some inflationary pressure, but if things slow down too much, this could drag out the recovery process for years to come. Are you still with me? Great, because S&P Global's Purchasing Manager Index, PMI, data already points to this troubling situation. We are witnessing an accelerated slowdown in hiring. Couple that with recent steep declines in factory output, and suddenly the idea of cutting interest rates multiple times in quick succession seems not only plausible but necessary. Here's another angle we can't ignore. China's economic struggles have spilled over into Europe in a big way. This isn't just an isolated continental issue for Europe. It's part of a larger global slowdown. With China's economy slowing down due to faltering property markets, hefty debt loads, and weakened consumer demand, Europe, particularly its manufacturing sector, is taking a serious hit. Manufacturing, the sector many firms were betting on as the recovery engine post-pandemic, is now dragging Europe deeper into recessionary territory. German industrial production fell sharply, with output receding by about 3.8% year-over-year as of the second quarter. This is no small matter, as Germany is Europe's economic backbone. And let's not forget about energy costs either. Europe is still grappling with high energy expenses post-Russian sanctions and disruptions, another factor eroding industrial competitiveness. While energy prices have stabilized from their 2022 highs, they remain elevated compared to pre-crisis levels. Sectors that rely heavily on energy inputs, like manufacturing and industrial firms, are seeing profits squeezed thinner than they have in years. BASF, ThyssenKrupp, Volkswagen, all of them hit hard by the dual forces of energy price stress and slowing global demand. You might be thinking, what's the rush to cut interest rates when inflation is still a problem? Wouldn't inflation shoot back up the moment rates get cut? Well, it's not that simple. The ECB, despite being mainly centered on inflation, knows full well that a labor market collapse would pose even greater risks in the long run. Rate cuts could alleviate some borrowing costs and potentially restore a little bit of consumer and business confidence. But keep in mind, the balance that must be struck here is delicate. You can't wing it. Otherwise, you risk inflating the already ballooned debt market even more or triggering a European version of stagflation, high inflation amid low growth. Goldman Sachs is predicting cuts at every meeting until the current deposit rate, hovering at 3.5%, falls to about 2%. This is huge, very aggressive, and it shows just how little time the ECB thinks it actually has before the window of opportunity closes and recession becomes the indisputable reality across the region. But, while lower borrowing costs should reduce the risk of even greater spikes in unemployment, it might not be enough to reinvigorate confidence in the broader economy. After all, corporations are increasingly apprehensive about the long-term outlook. Even with cheaper rates, they're reluctant to keep hiring or expanding, knowing the structural issues aren't easily solvable, especially with Europe's competitive disadvantages in cost and demand sitting on the horizon. So where are we now? Europe's labor market, although resilient for years, is showing cracks. And these cracks might eventually split wide open. The ECB, facing a rapidly changing economic landscape, will likely have no choice but to pivot toward aggressive rate cuts in the near term in hopes of preventing a prolonged economic depression. Yet, lowering interest rates won't be a panacea. Europe's manufacturing sector is still hurting, global demand remains sluggish, and China's woes are deeply affecting the continent. As unemployment threatens to creep back up, wage growth is moderating. However, that moderation in pay growth could reduce inflationary pressures in the short term, but it's a double-edged sword. If wages stagnate for too long and unemployment rises, you run the risk of stoking further economic weakness, making the prospect of a true rebound more distant. The European Central Bank, ECB, has found itself walking a tightrope. On one side, inflation still hovers uncomfortably above its 2% target, putting pressure on policymakers to avoid rate cuts, fearing the return of price surges that could destabilize the Eurozone economy even further. However, on the other side, rising unemployment and a slowing labor market signal that economic growth might be weakening faster than anticipated. In this context, there's increasing concern that if the ECB doesn't push for aggressive monetary loosening, they may not be able to prevent a full-blown recession, and the damage that could do would dwarf inflation risks. It's becoming clear that the labor market is serving as the canary in the coal mine for Europe's overall economic health. The recent weakness in employment growth and job vacancy rates, alongside a noticeable slowdown in new hiring, has created significant concern. Let's expand on this a little more. Right now, while overall unemployment remains at record lows, this isn't a sign that everything is peachy. Far from it. What we're seeing is that the pace of job creation has slowed dramatically. More alarmingly, the job vacancy rate, which reflects how many businesses are actively looking to hire, has also dropped. This singular metric, while often overlooked, actually serves as a precursor to a cooling labor market. When businesses stop looking for new employees, it suggests they lack confidence in the strength of future demand. Spain, for example, a major Eurozone economy, saw its job vacancy rate fall to 0.7%, down from 0.9% in the previous quarter. Spain, a country heavily reliant on tourism, hints at how sectors across the economy are increasingly hesitant about hiring amid economic uncertainties. France's rate fell to just 1.4%, down from over 2% during the post-pandemic recovery phase. This paints a grim picture across multiple sectors as business sentiment wanes. It's no surprise, then, why the ECB finds itself scrambling. Key officials like Mario Centeno, Isabel Schnabel, and Christine Lagarde recognize that, whether they have a dual mandate or not, Europe's employment situation directly ties back into the region's inflation and economic health. Across Germany, for example, various industries are unwinding. Volkswagen AG and others have recognized they can't continue staff hoarding, as they were doing before. And when multinational corporations start slashing payroll, that sends ripples. Less income leads to less consumption, further hitting already struggling service sectors. Let's break this down even further. Staff hoarding, the practice where firms hold onto workers despite weak output in fear of a future labor shortage, kept the labor market artificially tight post-pandemic. But now, with stronger inflationary pressures and demand cooling, this strategy is proving too costly. Firms like ThyssenKrupp AG and BASF SE have already announced job cuts, worried more about survival than long-term growth. While these cuts are slowly trickling in, there's fear that the dam may soon burst, leading to widespread layoffs across Europe's largest companies. If we zoom out from the corporate world and consider broader trends, the story remains the same. Surveys like the S&P Global Purchasing Managers Index point to large declines in hiring outlooks. Businesses in manufacturing and services alike are pulling back, showing less interest in expanding payrolls. Both of these trends together, weak industrial output and cautious services growth, are key indicators that Europe's resilience in employment could soon collapse further, causing a sharp climb in unemployment. Experts at Goldman Sachs have predicted that unemployment could rise to 6.7% in the next few quarters, a significant shift given how resilient the labor market has been up until now. At the heart of these concerns about the labor market is wage growth. The ECB has banked heavily on the idea that wage growth, which has become weaker in recent quarters, will help bring inflation down. Typically, strong labor markets lead to higher wage demands, which fuel inflation since companies pass rising costs off to consumers. However, the reality now is far more complicated. If the market continues to tighten, we're likely to witness workers tolerating lower wage increases just to keep job security. Workers across Europe could find themselves in weaker bargaining positions, accepting modest or stagnant wage hikes, which could help ease inflationary pressure. But here's the catch. While this may slow inflation, it comes at a cost. Lower wage growth means a further decline in domestic consumption, which is a key pillar holding up the European economy today. Barclays analysts suggest that workers, on average, are already being forced into negotiating lower-than-expected wage increases simply due to rising economic fears. So here's the question. Is that a trade-off the ECB is ready to accept? A slower wage growth profile does help reach that fabled 2% target in the short term, but it also has the potential to deepen the recession fears, particularly if low pay rises contribute to sluggish consumption. The ECB has already outlined its expectations, with Philip Lane, the chief economist, signaling that wage pressures would align with inflation goals in the medium term. But, as we know all too well with economic forecasts, medium-term assumptions can fall prey to short-term upheavals. If the large industrial indicators, like the ones we're seeing in Germany, continue spiraling downward, even moderate wage growth might not be enough to avert a bigger bust. What everyone wants to know is, will these rate cuts actually help? And how much deeper could the ECB go? The ECB has tentatively kicked off an easing cycle, and it's clear that cutting rates will continue to be tabled at every consecutive meeting until the deposit rate falls lower, from its current 3.5% down to about 2%, according to Goldman Sachs forecasts. However, rate cuts are a compromise, not a solution. Why? Because the real problem Europe faces isn't merely one of monetary policy but structural. Even if borrowing costs are lowered, businesses and consumers alike may continue to pull back. The manufacturing sector, in particular, faces serious external challenges that a couple of interest rate cuts can't fix. The competitive disadvantage that European firms have developed against the US and Asia, particularly China, cannot be ignored. External threats, like weakening Chinese purchasing power, are unlikely to improve in the near term, leading to lasting downstream effects on Europe's export-driven industrial powerhouses. Moreover, even as the cost of borrowing comes down, economic growth may continue to stagnate if confidence remains weak. People need to want to borrow at those lower rates, and for business investment to happen, there must be a more optimistic economic outlook. The interplay between monetary policy and actual results can be tenuous, especially when corporations are increasingly conservative about their future hiring plans and outputs. Lowering interest rates too quickly could even exacerbate existing problems if it leads to a rise in debt and speculative bubbles in the housing or investment markets, especially if the labor market collapses underneath it all. Europe cannot afford another financial crisis built on a house of cards. Let's not forget the broader geopolitical mess that Europe has been facing since Russia's invasion of Ukraine. While energy prices have cooled from last year's highs, they're still elevated versus pre-crisis levels, seriously squeezing profit margins for energy-intensive industries like chemicals and metals. The disruption in Europe's energy market has fundamentally impaired long-term pricing structures for industrial production. The reliance on alternative energy supply chains, largely through LNG, liquefied natural gas, imports from the US or Middle East, has brought in some stability, but Europe is far from out of the woods when it comes to high energy costs. As noted by Karsten Junius, an economist at Bank J. Safra Saracen, the ECB's rate cuts must also consider how much more external price pressures, like energy, will weigh on businesses and consumers. Europe's slow transition to renewable energy sources, coupled with volatile prices for gas and oil, leaves its economic performance especially vulnerable. In countries like Germany, where energy costs drive much of the industrial output, the continued uncertainty around affordable power could forcibly pull more firms into drastic cost-cutting measures, meaning more layoffs, shuttered facilities, and a greater drag on economic growth. So where do we stand now? Europe is moving forward cautiously into what looks to be an inevitable slowdown. All the major indicators, a deteriorating labor market, low consumer confidence, weakened industrial production, and global uncertainties, point toward a deeper recession unless decisive, well-timed action is taken. The sudden realization by ECB policymakers, like President Lagarde, that cutting rates must happen faster underscores how quickly things can shift. There's little room left for dithering, not when economic momentum is slowing, production metrics are falling, and companies like Volkswagen and ThyssenKrupp are abandoning hopes of quick rebounds. Yet, rate cuts, while certainly on the horizon, can't alone solve what's a much deeper problem of structural inefficiencies within Europe's economic and industrial frameworks. Europe's over-reliance on manufacturing, with strong dependencies on China's demand, simultaneously with its stagnating domestic consumption, will need a comprehensive rethinking. How do you reinvigorate an economy when even the manufacturing sector is struggling, the services sector is faltering, and consumers are tightening their belts? Europe is grappling with these fundamental issues, and solving them goes beyond just cutting interest rates. One of the underlying challenges Europe faces is that its industrial competitiveness has eroded over time. In countries like Germany, which are heavily dependent on manufacturing exports, the combination of weak global demand, particularly in China, high energy costs, and regulatory red tape is severely limiting growth potential. The competitive disadvantage with the US and Asia, worsened by supply chain disruptions and uncertainties in trade relations, has been a persistent drag on the industrial sector, particularly for companies that have historically fueled Europe's growth engine. Furthermore, Europe's fragmented fiscal policy presents another roadblock to a unified and more aggressive economic response. Unlike the US, where the federal government has greater direct control over economic measures and fiscal stimulus, the Eurozone comprises multiple sovereign states with their own priorities and policies. This lack of coordination creates inefficiencies and delays in implementing much-needed economic support, further exacerbating the impact of external shocks. Take the debate over European fiscal integration, particularly calls for a Eurozone-wide fiscal policy or expansion of initiatives like Next Generation EU, a €750 billion recovery fund. While the fund was a powerful tool in stabilizing economies post-pandemic, many argue that it's a temporary measure, a bandage on a fundamentally flawed setup. Germany, known for its fiscal conservatism, is often reluctant to embrace large-scale fiscal stimulus, which can put it at odds with southern European nations like Italy and Spain, where public debt levels are significantly higher. These policy divides deepen the cracks in Europe's ability to act decisively on macroeconomic challenges. European growth has also been stifled by chronically low investment rates. Business investment is a key driver of economic expansion, and when businesses are too risk-averse to invest in new technologies, infrastructure, or even human capital, the economy stagnates. Low investment reflects the gloomy sentiment across industries, a sentiment exacerbated by economic uncertainties and a rapidly shifting global landscape, notably around digitalization and green technology transitions. Compared to the US and China, Europe lags behind in crucial areas like technology and innovation. For example, while countries like Germany have historically dominated in industrial production and mechanical engineering, they are falling behind in digital innovation and software development, crucial sectors for the modern economy. The lack of homegrown tech giants, comparable to Apple, Amazon, or Alibaba, presents a massive challenge. What's worse, venture capital financing for European startups remains a fraction of what's available in the US or China, making it harder for innovative European firms to scale up and compete globally. This innovation deficit isn't just about tech. It's also about green energy transitions. The Eurozone has committed to ambitious climate targets, yet there's growing unease that it's not innovating fast enough in renewable energy technology, battery storage, or electric vehicle supply chains. Meanwhile, China has geared its industrial base toward domination in green technologies, a sector that will define the next decade's growth. Europe, at this point, is playing catch-up, with struggling firms like Volkswagen and Continental highlighting just how challenging it is to transform long-standing industrial practices in a short amount of time. Let's shift focus to consumer sentiment, which is an absolutely critical component of Europe's economic health. The consumer is the backbone of any economy, and in Europe, consumers are facing multiple headwinds that threaten to choke off any chance of a recovery. The cost of living crisis, stemming from high inflation over the past year, has taken a significant toll on household budgets. While inflation has moderated from its earlier peaks, it remains above the ECB's 2% target, meaning that groceries, energy bills, and basic services are still more expensive than they were 2 years ago. Real wages, which account for inflation-adjusted income, have stagnated, and in some cases even declined. A recent report from Eurostat showed that in several countries, including Spain and Italy, real wages are down compared to pre-pandemic levels. This combination of high prices and low wage growth is particularly damaging, as it leaves consumers with less disposable income to spend on goods and services, further pressing on demand and slowing any potential recovery in service sectors like hospitality, retail, and entertainment. In particular, southern European economies, which are more dependent on tourism and consumption-driven growth, face the most acute struggles. Portugal and Greece, for instance, are seeing slower tourism recoveries than expected, and domestic spending is still well below pre-pandemic levels. These economies are highly sensitive to changes in consumer sentiment because their labor markets are heavily skewed toward service sectors, which rely on consistent consumer demand. Moreover, consumer confidence across the Eurozone remains weak, with index readings showing pessimism about future financial conditions. The European Commission's economic sentiment indicator fell again in recent months, indicating that consumers are tightening their belts instead of expanding spending. For all the ECB can do in terms of interest rate adjustments, it's hard to stimulate growth when consumer sentiment is in the gutter and people are more inclined to save rather than spend. So, given the myriad problems the Eurozone economy is facing, Is the European Central Bank's approach of cutting rates a silver bullet? Not quite. In fact, the ECB faces one of the toughest balancing acts among the world's major central banks. Having already aggressively hiked interest rates in response to the inflation shock, the risk now is that easing too quickly could result in persistent inflationary pressures while failing to materially boost growth. The ECB's main mandate, price stability, is still far from being successfully met. While inflation has cooled in recent months, driven by temporary factors like lower energy costs and softer demand, the underlying structural inflation, driven by wage increases and supply constraints, remains sticky. As the ECB considers further rate cuts, it's walking a tightrope. Cut too fast and it could reignite inflation. Cut too slow and the Eurozone could sink further into recession, with unemployment rising and consumer demand dropping alarmingly fast. One issue compounding this problem is inflation expectations. Research shows that consumer and business expectations about future inflation are crucial in shaping actual inflationary outcomes. In other words, if people expect prices to rise, they adjust their behaviors accordingly, demanding higher wages, increasing prices for goods and services, or shifting investment strategies. This is why the ECB has been so cautious in signaling any sharp pivots toward easier monetary policy without first getting a clear handle on inflation. Seeing this dilemma play out is frustrating for those expecting a swift and decisive recovery. However, given how inflation, labor market dynamics, and confidence interact, it makes sense why the ECB is hesitant to overpromise. Barclays economists recently wrote that, while the ECB faces building pressure from the labor market and growth data, rushing rate cuts could lock in higher inflation while leaving structural growth problems unresolved. This is the essence of the ECB's challenge. Europe's economic outlook appears clouded as we look forward. But what are some of the pathways out of this bind beyond ECB rate cuts? 1. Structural reforms. If Europe is going to restore competitiveness, structural reforms are essential. This means easing regulatory barriers for innovation, improving labor market flexibility, and increasing investment in industries of the future, particularly digital and green technologies. European governments must get serious about initiatives that bridge the gap between their industrial past and their digital future. Consider the need for massive infrastructure investment, particularly in broadband, renewable energy, and electric vehicle charging networks. Countries like Germany, the Netherlands, and France need to lead the charge in building the technological foundation that can stimulate long-term growth. Efforts like Germany's Gigabit Germany initiative, aimed at improving high-speed internet infrastructure, are steps in the right direction, but more will be required. 2. Targeted fiscal support. Monetary policy on its own isn't enough. Fiscal stimulus through government spending is essential, particularly in the face of a deteriorating labor market. Policymakers in Berlin, Paris, and Brussels need to reprioritize spending on social programs, job retraining schemes, and investment in future industries. Europe can also learn from the U.S. approach, where the government engaged in infrastructure-driven stimulus with programs like the Infrastructure Investment and Jobs Act, which helped alleviate post-pandemic economic bottlenecks and provided strategic investment into future growth sectors. This kind of aggression is what's required in Europe, although getting the Eurozone-wide political consensus to fund such programs may prove difficult. 3. Global trade partnerships. As China becomes an increasingly unreliable trading partner for Europe, particularly with its own economic weaknesses, there needs to be a strategic pivot in how Europe engages the rest of the world, building stronger trade relations with India and Southeast Asia, diversifying supply chains out of China, and reducing reliance on U.S. supply chains post-Brexit will be critical for boosting Europe's export-driven economies. The EU-India Free Trade Agreement, still under negotiation, could be a game-changer, offering new avenues for European businesses and alleviating some of its heavy reliance on Chinese demand. 4. Investment in education and labor skills development. With automation on the rise and the demand for advanced digital skills increasing, Europe needs to double down on education and labor skills development. If Europe is to successfully transition towards a digital and green economy, its labor force must be equipped with the necessary skills. According to McKinsey & Company, Europe is facing a skills gap, particularly in fast-growing areas like technology, renewable energy, and advanced manufacturing. Jobs of the future will require more technical expertise in fields like data science, artificial intelligence, AI, green technologies, and advanced robotics. Countries like Germany, which have historically excelled through apprenticeships and vocational training, must expand these models to include expertise in new skills. The EU should prioritize substantial investments in upskilling its workforce to provide adults with continuous education opportunities, reshaping labor markets to be more responsive and resilient to global competition. Both public and private entities need to collaborate on reskilling programs that address the challenges of automation and digitalization. This would enhance productivity and reduce the long-term unemployment that stagnates many economies in Southern Europe. Moreover, addressing youth unemployment should be a top priority. Youth unemployment remains high in many parts of the Eurozone, particularly in countries like Spain and Greece, where youth unemployment rates were between 20 to 30% as of the last quarter. Without targeted interventions, the long-term societal and economic impacts of high youth unemployment could undermine Europe's future competitiveness. Another crucial area that cannot be ignored is Europe's energy predicament, heightened by the sanctions placed on Russia post-invasion of Ukraine. Energy prices, while stabilizing somewhat, remain both volatile and elevated in comparison to pre-crisis years. This affects every aspect of Europe's economy, making it all the more difficult for industries reliant on cheap energy, such as chemicals, manufacturing, and metals production, to remain competitive. A true recovery for Europe will require a serious overhaul in how the region approaches its energy supply, pricing, and sustainability. The good news is, Europe has recognized this with the European Green Deal, aimed at making Europe the first climate-neutral continent by 2050. Initiatives like REPowerEU, the EU's strategic initiative to phase out Russian fossil fuels, signal a pivot away from reliance on geopolitically volatile regions for energy supplies. But these are long-term solutions to a short-term crisis. So, in the near term, how does Europe address this energy cost crunch that is hitting both industry and consumers? 1. Diversification of energy sources. The first step is fast-tracking the diversification of energy sources. Europe has made efforts to increase liquefied natural gas, LNG, imports from countries like the United States, Qatar, and Norway, but the infrastructure for fully utilizing these new supply chains isn't yet ready. Investment in building out LNG terminals, pipelines, and storage facilities is critical. Additionally, reliance on more intermittent renewable energy like wind and solar puts a spotlight on the need for energy storage technologies and the development of green hydrogen solutions, which could provide a more stable base supply while reinforcing Europe's sustainability goals. 2. Energy subsidies and support for consumers. On a more microeconomic scale, countries will need to provide immediate relief to households struggling with energy bills, ensuring that disposable incomes don't collapse entirely as a result of soaring energy costs. Many member states have implemented partial energy subsidies or short-term credits, but this is not universally applied. Ensuring fair distribution and stronger fiscal policies to prevent energy poverty should top the agenda, especially throughout upcoming winters, where consumption shoots up considerably. 3. Energy efficiency initiatives for industry. For Europe's energy-intensive industries, energy efficiency needs to be at the heart of the immediate recovery strategy. Investment in industrial retrofitting, green technology adoption, and enhanced energy audit programs could help mitigate costs in the medium term. Europe must also leverage its capacity for innovation in energy technology, particularly to reduce dependence on carbon-intensive processes. For example, Spain and Portugal are already leading green hydrogen developments, given their vast sunlight potential, and could offer a blueprint for other EU member states to adopt similar practices. However, other countries, particularly those with colder climates, such as Germany or Austria, need to also make parallel advancements in energy storage and grid enhancements to improve the flexibility of renewables across weather conditions. Now let's talk about fiscal policy, a persistent sticking point in Europe. While the ECB can manipulate monetary policy, ensuring that interest rates support growth, fiscal integration across the Eurozone remains a difficult issue. The Next Generation EU recovery package, announced after the pandemic, set an important precedent, but is only a temporary solution to deeper fiscal coordination issues. Take the EU-wide debt issuance as an example. The European Union has notoriously been reluctant to emulate the US model of centralized government debt funding, instead deferring much of that burden back to individual member states. Countries like Germany, with strong fiscal discipline, often resist expanded shared borrowing mechanisms because they fear being on the hook for spending in more fiscally lax countries. Italy, for example, has a public debt load of over 144% of GDP, one of the highest levels in Europe. To ensure sustainability, tools like joint debt issuance could offer relief to countries struggling with debt fatigue, but there's no political consensus. The EU's next step must be towards stronger fiscal integration. This could help finance large-scale infrastructure projects, support member states during crises, and encourage long-term competitiveness. The lack of a common fiscal policy limits the EU's ability to effectively use fiscal tools, like universal stimulus programs, that can smooth over differences between stronger and weaker economies. A proper economic union requires moving from simply a monetary union to building out a full-fledged fiscal union, which allows the ability to respond to asymmetric shocks. This includes better coordination on tax policies, addressing loopholes that allow for tax dumping, where individual states offer lower tax rates to lure businesses, which undermines collective fiscal responsibility. A more ambitious approach could involve the introduction of Eurozone-wide bonds or fiscal transfers from stronger economies to weaker economies, similar to how federal transfers work in the US. This would ensure that when one part of the union is acutely hit by a financial or economic crisis, the entire union can absorb the impact rather than relying on individual nations. We can't overlook the geopolitical factors that are contributing to Europe's current economic malaise. The Brexit fallout continues to impose challenges, particularly for Great Britain, but also extends across the continent, unraveling decades of supply chain integration. Financial firms, from Deutsche Bank to BNP Paribas, have shifted focus from London, no longer viewing it as the uncontested financial capital of Europe. This realignment is costly in terms of both administration and efficiency. The services sector, particularly financial services, has borne much of the Brexit brunt, with firms restructuring their operations to cater to both UK and EU clients, often leading to redundancies. Moreover, global tensions stemming from US-China trade relations pose further risk. With Washington taking a hardliner stance on China and potentially reshaping its global manufacturing footprint, Europe will need to navigate these tensions delicately. Supply chains are likely to fragment further, impacting Europe's export capacity. Germany, in particular, is dependent on Chinese demand for key industries, such as automotive and industrial machinery. And with China's slowing economy and weakened real estate market, Germany and the broader Eurozone stand to lose a significant chunk of their export market, putting even more weight on domestic demand, which, as we've noted, is already subdued. Ultimately, the Eurozone faces a historical crossroads. The next few years will define whether Europe remains a leading force in the global economy or plays catch up to more dynamic regions like the US, China, and India. Europe has natural strengths it can lean on, including its deep institutional framework, advanced environmental initiatives, and a communal social ethic that prioritizes citizen welfare. However, without significant policy shifts, from fiscal coordination to labor market reforms and energy policies, the Eurozone risks sliding into a long period of stagnation, which could have repercussions not just for the continent but for the global economy. At its heart, the ECB strategy is just one piece of the puzzle. The broader structural issues in manufacturing, innovation, and fiscal unity must be addressed in tandem to foster long-term sustainable growth. The region has weathered crises before, from the 2008 financial crash to the 2012 debt crisis. But this time, the challenges are multifaceted. It's not just a cyclical downturn anymore. It's an era-defining moment. The labor market, wage growth, competitiveness, and innovation are all in play, and it's up to policymakers to keep Europe out of an economic sinkhole. With looming political pressures, a volatile external environment, and growing domestic dysfunction, the stakes could not be higher. More than ever, Europe needs visionary leadership, both at the ECB and among EU governments, to avoid plunging into deeper recessions while keeping inflation and unemployment in check. The continent's future prosperity and global standing depend on it. In wrapping up, the Eurozone is entering a crucial period that will require policy decisiveness, innovation, and a more integrated approach to fiscal and labor market challenges. The easy run of resilience in the euro area's labor market has come to an end, as cracks are beginning to widen. The dominoes are falling at key junction points. Manufacturing output is slumping, corporate confidence is declining, and consumption is weakening, all while inflation pressures slowly linger in the background. The ECB is now forced to juggle multiple crises at once, addressing inflation without breaking the economy's back, while maintaining employment stability and propping up collapsing industrial sectors. Yet, Beyond the central bank's levers of interest rates and liquidity adjustments, the core issues facing Europe's economic future stretch much deeper, to fiscal policies, geopolitical shifts, and the structural capacity of European industries themselves. As we look forward to the next several quarters, the key focus areas will be the labor market, fiscal policy integration, and the transformation of Europe's industrial competitiveness. Here's a quick look at what might unfold across these critical areas. 1. Labor market developments. While the labor market has been the backbone resisting broader economic downturns in Europe, expect continued erosion in employment growth as industrial layoffs mount over the coming months. The once reliable manufacturing sector, weakened by external pressures such as lower Chinese demand and rising energy costs, will likely be forced into deeper restructuring, leading to more job cuts in large, historically stable firms like Volkswagen AG, ThyssenKrupp AG, and BASF SE. Additionally, we might see a growing discrepancy between northern and southern European countries when it comes to the labor market. Southern European nations, with their traditionally weaker economies and higher unemployment rates, could tip even further into joblessness, dragging down average numbers across disciplines. Meanwhile, highly skilled labor in northern economies may remain more resilient, but even Germany's job market won't be immune to industrial restructuring. Whether policymakers can stem the potential for a snowballing job market crisis will be one of the defining features of this downturn. 2. Interest rate cuts. Market consensus points toward further ECB rate cuts, with Goldman Sachs predicting a deposit rate of 2% after another series of cuts. The question will be, how much is enough? Can lower borrowing costs resuscitate business investment, or is the broader malaise too structural for rate cuts to have much effect? Expect the ECB to adopt a wait-and-see approach, cutting rates at each successive meeting but analyzing real-time labor data and inflation trends. As Isabel Schnabel, the ECB executive board member, has suggested, the deeper softening of the labor market might force a recalibration of their timeline for cuts, making ECB officials more aggressive in their policymaking. A sharp cut might be needed if unemployment suddenly spikes, but we can only hope this doesn't come too late, as real damage to business confidence may already be done by then. 3. Wage growth and inflation dynamics. For ordinary Europeans and workers across the Eurozone, the next few years could see wage growth continuing to stagnate or rise slowly. As labor markets weaken, employees may reluctantly accept modest wage increases in exchange for job security, which in turn would ease inflationary pressures in the medium term. The interactions between wage demands, inflation expectations, and real disposable income levels will be critical going forward. The ECB's assumption that it can sustainably hit its 2% inflation target by late 2025 rests largely on this slowdown of wage growth. We have to remember, however, there's a risk. If real wages fall too dramatically, domestic consumption could take a bigger nosedive than anticipated, dragging down the entire economy's momentum. Countries like France, Italy, and Spain, where consumer expenditure drives much of the economic activity, would feel the pressure the hardest. 4. The geopolitical environment. In the broader geopolitical landscape, Europe's place in the world will significantly affect its economic trajectory. The economic relationship with China represents a precarious balancing act. Just as Europe's economies, especially Germany, were banking on sustained demand from China, the Chinese slowdown has shot that assumption. With China's real estate crisis unraveling and its gradual shift towards domestic consumption, Europe is forced to rethink its trade strategy. Similarly, US-China tensions will continue to spill over into Europe, making Eurozone firms recalibrate their supply chains as localization of production becomes more important than ever. Energy sanctions placed on Russia will likewise continue to reverberate through global energy markets, leaving Europe exposed to energy price volatility, especially during winter months where renewed gas shortages could hit household consumption and industrial production alike. Post-Brexit realignments will persist too. As Britain disentangles itself from the EU by building independent trade agreements, the implications for heavy manufacturing hubs in countries like Germany, which relied heavily on deeply integrated Anglo-European supply networks, could still bring complications. The friction-filled cross-channel relationship remains vital to Europe's planning over the medium term. 5. Industrial competitiveness and energy transition. Europe is now confronting the unavoidable fact that its industrial base needs a renaissance if it's to remain globally competitive. With high energy prices remaining a chronic issue, The bloc's industrial sector is disadvantaged against cheaper-cost regions like Southeast Asia and the US, where geopolitical energy security is stronger. Energy transition projects will gather steam, particularly around renewables and technologies like green hydrogen, technologies where Europe has a genuine chance to lead. However, the momentum behind these green projects must increase significantly if Europe is to decarbonize its supply chains and power its industries without being financially crippled by high energy costs. In countries like Spain, advances in green hydrogen technologies offer hope, while France is pushing aggressively to modernize its nuclear energy fleet, rewriting its energy security goals. Yet, few can overlook the geographical and structural differences across Europe, with countries in Central and Eastern Europe much more reliant on traditional fossil fuels. How Europe bridges this regional divide while transitioning to clean energy will determine the outlook for industrial competitiveness. 6. Policy coordination and fiscal unity. Finally, the dream of a fiscally integrated Europe remains elusive, but the next steps will need to target precisely that. Without a deeper commitment to shared fiscal responsibility, joint debt issuance, and distributed fiscal authority between Southern and Northern Europe, the gaps in financial strength across member states will only worsen during downturns. Even today, debates about reforming Europe's fiscal rules are intensifying, with Italy and Greece pushing for looser rules to allow more fiscal flexibility, while Germany insists on maintaining fiscal discipline. Expect more discussions in the coming years around expanding recovery funds such as Next Generation EU, potentially pushing for permanent fiscal instruments like a European Treasury bond, as demanded by Italy, Spain, and other debt-stricken nations. These debates will test European solidarity to its core, but solving the fiscal integration challenge is central to Europe's future cohesiveness. In the end, Europe faces a particularly complex economic landscape, one where monetary policy will only go so far, and comprehensive policy adjustments will require vision and coordination across national, regional, and industrial boundaries. The ECB is doing what it can to balance economic growth against inflation, but it cannot be the sole actor in resolving Europe's deep-rooted structural challenges. European governments, corporations, and households will all have to act in tandem to navigate this turbulent period. Whether it's investing in next-generation technologies, closing the gap on renewables, or deepening fiscal coordination within the Eurozone, Europe's growth will not be handed to it easily. The troubles of Europe's job market and industrial sectors are not isolated. They are deeply interconnected with global shifts in trade, geopolitics, technology, and economic models. The labor market cracks, once small, are now widening into fractures that could erode Europe's long-standing economic foundations. But we've seen time and again how Europe, facing enormous crises, can adapt. And this time will need to be no different. The path to recovery, though steep, is still navigable. But Europe needs boldness, not timidity, from its policymakers, industries, and citizens alike. The decisions made in the next few years will define Europe's economic place in the world for decades to come. To remain competitive, sustain social stability, and secure brighter futures for its younger generations, the Eurozone must reshape its economic framework, bolstered by fiscal reform, global innovation, and community-driven economic strategies. Only by doing so can it emerge stronger, more united, and more resilient. As we monitor these unfolding events month by month, stay tuned to our channel, where we'll keep you updated and analyze the ever-evolving economic landscape. Let's see if Europe can make a U-turn from today's uncertainties, because whatever comes next, it's going to dictate the future not only of the Eurozone, but of global economic dynamics at large.